silver and gold did not creep higher at the end of December. They jumped. In the final days of the month, silver surged toward $70 per ounce, while gold pushed decisively beyond $4,400. These were not marginal moves, not the kind traders shrug off as noise. They were the kind of price shocks that force even seasoned investors in the United States to pause, refresh their screens, and ask the same uneasy question: what just changed? Only a few weeks earlier, silver hovering in the low 60s already felt expensive to many retail buyers. Now, with spot prices racing upward day after day, the metal was suddenly behaving less like an industrial input and more like a geopolitical signal. Gold followed closely, reinforcing the message. When both metals move together at this speed, markets are rarely reacting to a single headline. They are responding to fear, policy expectations, and the quiet realization that the old assumptions may no longer apply. For American investors, the timing is not accidental. Inflation may have cooled from its peak, but it has not disappeared from household budgets. Interest rate cuts are being discussed more openly, even if no one at the Federal Reserve wants to admit it too loudly. Government debt continues to climb, deficits roll on without restraint, and confidence in long-term monetary discipline remains thin. In that environment, gold and silver regain their oldest role, not as speculative trades, but as insurance policies against a system that feels increasingly stretched. In the most recent trading sessions, silver recorded daily gains measured in multiple percentage points, while gold added well over $100 in a matter of days, marking one of the strongest short-term advances of the year. Those numbers matter, not just because they look impressive, but because of what they imply. Moves of this size tend to attract momentum traders, algorithmic funds, and latecomers chasing headlines. That is when volatility feeds on itself. There is a familiar irony here. Many voices in the market are quick to say they saw this coming. The same people, only months ago, dismissed precious metals as dead money in a rising rate world. Now, with prices at historic levels, the surprise has become collective amnesia. Everyone claims foresight after the fact. The market, as always, is less forgiving in real time. Behind the dramatic price moves in silver and gold lies a set of macroeconomic forces that American markets understand well, even if they prefer not to dwell on them for too long. The rally is not happening in a vacuum. It is unfolding against a backdrop of shifting expectations around interest rates, currency strength, and the broader credibility of monetary policy. In other words, the metals are reacting to the same signals investors watch every day, but they are reacting faster and with less patience. The US dollar, while still dominant, has shown renewed signs of weakness. Every dip in the dollar index acts like lighter fluid for precious metals, and recent sessions have been no exception. At the same time, conversations around future rate cuts have grown louder. Officials may insist that policy remains data-dependent, but markets have already begun to price in a softer stance ahead. For metals like silver and gold, that anticipation matters almost as much as the decision itself. Lower real yields reduce the opportunity cost of holding non-yield assets, and capital moves accordingly. What makes this moment different is speed. In the past week alone, futures markets priced in a higher probability of rate reductions within the coming year, coinciding with one of the sharpest weekly gains in precious metals seen in recent months. The message from traders is blunt. They are no longer waiting for official confirmation. They are acting on the assumption that tighter financial conditions have reached their limit. For American investors, this creates a familiar contradiction. On one hand, equity markets continue to project confidence, buoyed by optimism around technology and corporate earnings. On the other, money is flowing into assets traditionally associated with caution and crisis. Gold and silver do not rally like this because everyone feels comfortable. They rally because enough people quietly do not. There is also an unmistakable tone of skepticism toward official narratives. Each reassured statement from policymakers is met with another wave of buying in metals, as if the market is politely listening while doing the opposite. It is a subtle form of protest, one that does not involve speeches or votes, only capital allocation. The irony, of course, is that markets claim to hate uncertainty, yet they consistently price it in before it arrives. Precious metals are simply the most honest expression of that instinct. They move not on promises, but on probabilities. The conversation around silver changes tone the moment China enters the picture. What had looked like a familiar cycle of inflation, hedging, and rate speculation suddenly takes on a strategic dimension. According to the original analysis, China is preparing to tighten controls on silver exports starting at the beginning of the new year, a move that immediately reframes the market. This is no longer just about price. It is about access. The numbers tell a quiet but unsettling story. Chinese silver inventories have fallen steadily, reaching levels not seen in roughly a decade. That decline did not happen overnight, and it did not happen by accident. It reflects years of industrial consumption, limited new supply, and a growing awareness in Beijing that silver is no longer a metal that can be treated casually. Electronics, solar panels, advanced manufacturing, and defense-related technologies all compete for the same material. When stockpiles shrink, policy follows. Recent market data published within the past week confirms that silver inventories across major Asian exchanges continue to trend lower, with drawdowns accelerating as the year comes to a close. Analysts now point to sub-500-ton levels as a psychological and logistical threshold, reinforcing concerns about supply resilience. This timing matters. Export controls introduced during a period of already elevated prices send a clear message. Domestic priorities come first. From a Western perspective, this is often framed as market interference. From Beijing's perspective, it looks more like risk management. Nations that learned hard lessons during previous supply chain shocks are now acting earlier, not later. When the same behavior comes from the United States under the label of national security, it is called prudence. When it comes from China, it is called manipulation. The metal itself does not care. For American investors, the implication is uncomfortable. A significant portion of global silver supply is now subject to political decisions, rather than pure market forces. That introduces a structural uncertainty that paper contracts and spot charts struggle to capture. Silver is no longer just reacting to economic cycles, it is reacting to state strategy. The deeper irony is that these moves often validate the very fears driving investors into metals in the first place. Governments restricting resources tend to confirm, rather than calm, market anxiety. In that sense, China's actions do not suppress silver's appeal, they amplify it. Once silver is viewed through the lens of state behavior, the discussion naturally shifts from markets to resources. What had long been treated as a hybrid metal, part industrial input, part speculative asset, is increasingly being framed as something more consequential. The original analysis already pointed in this direction, emphasizing silver's expanding role across energy, technology, and defense. Recent developments have only sharpened that argument. Silver now sits at the intersection of multiple strategic priorities. It is embedded in solar panels, electric grids, semiconductors, data centers, and advanced weapon systems. Unlike many commodities, there is no easy substitute that matches its conductivity and reliability at scale. That technical reality has begun to matter politically. In the past several days, renewed commentary from market analysts has highlighted silver's importance for artificial intelligence, infrastructure, and next-generation energy systems, reinforcing the idea that demand growth is structural rather than cyclical. This is not a seasonal surge, it is a long-term shift. For years, policymakers spoke comfortably about the transition to cleaner energy and smarter technology without dwelling on the material constraints behind those ambitions. That luxury is fading. Every large-scale infrastructure plan eventually collides with the limits of physical supply. Silver is one of the metals where that collision is becoming visible first. Production has not kept pace with consumption, and new mining projects remain slow, expensive, and politically contentious. The United States has already begun to acknowledge this reality, even if the conversation remains cautious. Strategic materials are no longer discussed, only in terms of oil and rare earths. Silver is quietly moving into that category, not because of ideology, but because of math. When demand rises across multiple critical sectors at once, flexibility disappears. There is a certain irony in watching this unfold. Markets spent decades treating silver as the cheaper cousin of gold, useful but secondary. Now it is the metal tied most directly to the technologies policymakers claim will define the future. The same voices that once dismissed silver as redundant are now forced to explain why it appears in nearly every blueprint for modernization. The tone of the debate has changed as well. Optimism about innovation remains, but it is increasingly paired with concern about bottlenecks. Silver has become one of those bottlenecks. In that sense, its price behavior looks less like speculation and more like a delayed recognition of reality. As silver's strategic importance becomes harder to ignore, attention turns inevitably to the physical market, where theory meets constraint. The original analysis stressed a critical distinction that often gets lost in headline-driven coverage. The difference between silver traded on screens and silver that actually exists in vaults, warehouses, and supply chains. That difference is now widening, and it is doing so at an uncomfortable pace. On paper, silver appears abundant. Futures contracts change hands in volumes that dwarf annual mine production, creating the impression of deep liquidity. In the physical world, the picture looks very different. Fabricators, refiners, and industrial buyers operate within tighter margins, longer lead times, and fewer alternatives. When inventories fall, they cannot simply print more supply. Recent supply estimates released over the past week point to a continuation of global silver deficits, marking yet another year in which demand outpaces new production by a significant margin. This is no longer an anomaly. It is becoming a pattern. Industrial consumption remains the key driver. Solar manufacturing alone absorbs a growing share of annual output, while electronics and defense applications add layers of non-negotiable demand. Unlike investment buying, these sectors do not exit the market when prices rise. They adjust budgets, pass costs downstream, or seek government support. The silver still has to be sourced. That rigidity places increasing strain on available stockpiles, especially when investor interest surges at the same time. For American buyers, the contradiction is striking. Prices signal abundance, yet availability suggests scarcity. Premiums on physical products fluctuate wildly, sometimes detaching from spot prices altogether. It is an old story in precious metals, but one that intensifies when supply tightens structurally rather than temporarily. The market can tolerate speculation. It struggles with depletion. There is a deeper irony at work. Financial innovation was supposed to make commodities more efficient and accessible. Instead, it has created layers of abstraction that mask real-world limits until they can no longer be ignored. When silver becomes difficult to source, no amount of paper trading can solve the problem. At that point, price is not discovery, it is rationing. This is why concerns about physical silver resonate more loudly now than in previous cycles. The issue is not whether demand exists, it is whether supply can respond. Increasingly, the answer appears to be no, at least not quickly enough to keep markets comfortable. From the American perspective, the silver rally exposes a familiar split in investor psychology. Long-term narratives and short-term behavior rarely align, and the current market is no exception. The original analysis noted a growing sense of accumulation among U.S. buyers, driven less by speculation than by a desire for protection. That trend has not reversed. If anything, it has intensified as prices continue to test levels that once seemed improbable. Retail investors in the United States increasingly frame silver as a hedge against two overlapping risks: persistent inflation and an expanding federal balance sheet. Public debt continues to rise with little political appetite for restraint, while budget deficits roll forward as if immune to consequence. In that environment, tangible assets regain appeal, even at elevated prices. The logic is simple. Paper promises multiply faster than physical supply. Surveys and market commentary published within the past several days indicate that a majority of retail participants now expect silver prices to remain elevated into the coming year, with a significant portion forecasting further upside, despite acknowledging heightened volatility. This dual belief captures the mood perfectly. Confidence in the long-term thesis coexists with anxiety about near-term swings. Professional investors, meanwhile, display more caution. Many acknowledge silver's structural demand story, while warning that sharp corrections remain possible after such a rapid ascent. The metal has moved too far, too fast, by any historical measure. Yet even among skeptics, the argument is no longer about whether silver matters. It is about timing. Few are willing to dismiss the broader case outright. This divergence creates tension. Long-term holders speak of fundamentals, deficits, and strategic demand. Short-term traders watch charts, momentum, and positioning. Both groups influence price, but they operate on different clocks. The result is a market prone to abrupt reversals that do little to undermine the underlying thesis, yet test the patience of anyone without a long horizon. There is an almost ritual quality to these debates. Every rally invites warnings of collapse. Every dip is framed as an opportunity. What has changed is the backdrop. Silver is no longer rising in isolation. It is rising alongside policy uncertainty, geopolitical friction, and structural shifts in industrial demand. That makes today's arguments feel less academic and more consequential. For American investors, the question is no longer whether silver belongs in the conversation. It is whether they are prepared for the discomfort that comes with holding an asset caught between financial markets and physical reality. When all the threads are pulled together, the recent surge in silver no longer looks like an isolated market event. It looks like a convergence. Monetary policy uncertainty in the United States, tightening resource controls in China, rising industrial dependence, and persistent physical deficits are colliding at the same moment. The original analysis framed this as a transition, and the data now supports that framing with uncomfortable clarity. Silver is no longer behaving like gold's understudy. It is responding to pressures gold does not face in the same way. Gold can sit quietly in vaults as a monetary hedge. Silver is consumed, embedded, and transformed into infrastructure. Every solar panel installed, every data center expanded, every defense system upgraded quietly removes ounces from the market. Those ounces do not come back. Recent end-of-year market summaries show silver closing the period near multi-decade highs, with volatility elevated but demand indicators remaining stubbornly strong. That combination rarely resolves itself gently. From Washington to Beijing, policymakers speak increasingly in the language of resilience and security. Supply chains are scrutinized, export controls normalized, and strategic stockpiles discussed openly. In that world, metals like silver drift out of the purely financial sphere and into the realm of national interest. Markets tend to notice these shifts late, often after prices have already adjusted. For American audiences, this raises an uncomfortable but necessary question. Is the current price action a speculative excess that will fade, or a delayed repricing of a metal whose importance was underestimated for too long? The answer may not be immediate. Markets rarely offer clean conclusions. What they offer instead are signals, and silver is sending one with unusual volume. There is also a quiet irony worth acknowledging. For decades, silver was dismissed as too abundant, too volatile, too industrial to matter strategically. Now it sits at the center of debates about energy, technology, and security. The metal did not change. The world around it did. Thank you for watching, and before you go, let us know what you think about silver's role in this shifting global landscape, and whether you see this rally as a warning sign or an opportunity by leaving your thoughts in the comments.